International Energy Agency. Indeed, this year marks the review's 70th anniversary. The review is a trusted source of objective data for governments, industry, academics, and media worldwide. It has been recognized for outstanding contributions to the field of energy economics. The review provides a comprehensive overview of what happened in the world of energy last year for all forms of energy. And it puts today's data into consistent historical time series and provides all that data to the public. Moreover, it changes with the times. This year's edition, for example, adds new data on natural gas flaring, as well as wind and solar generating capacity. I encourage you all to download the report and the associated spreadsheet and explore the data for yourself. And today, we have the honor to host Michael Cohen, who is Chief U.S. Economist and Head of Oil Analysis at BP. A link to Michael's bio is on our website. Before joining BP, he led the commodity analysis at Barclays and worked at both the International Energy Agency and the U.S. Energy Department. He's also been gracious enough over many years not to rub his Ohio State degree and their decade-long football winning streak against my University of Michigan Wolverines in my face. And for that, Michael, thank you. Michael will walk us through some of the review's key findings. Then I will moderate a session based on your questions, which you can send to us using the Q&A function on the bottom of your screen. With that, Michael, welcome and over to you.
Thanks very much, Mark. It's really a privilege to be here with all of you from the Rice University community, the Baker Institute for Public Policy, and all of you tuning in that are just wanting to learn more about what happened in 2020 and what it means for our society as we face an energy transition. So I'm going to share a screen here. If you'll just bear with me for 1 second. And I want to first say thank you to Mark because this is something that BP has been producing for many years, but is also something that requires truly a team effort and requires years after years of honing a process with our partners at Heriot-Watt University that is not something that's very easy to do amid all of the other things that we in our group called Economic and Energy Insights are called on to do. And we know there are a lot of other entities, including EIA and IEA, that are producing similar types of data. But as Mark mentioned, the fact that we can produce this in a comprehensive manner, in a way that allows for comparative analysis across countries, makes it relevant and makes it important for establishing a foundation upon which we base our forecasting. And for that, it is really an essential tool as part of how we look at the world. So I'm going to split the discussion this morning into 3 main topics. What happened in 2020, what was surprising about it, and then also use this as an opportunity to look back over the last 5 years since the Paris Agreement was concluded, what has happened in the energy system versus what was initially forecast. And so as Mark mentioned, we've been doing this for 70 years. It's tracked the Suez crisis, the Fukushima disaster, the global financial crisis, any kind of energy crisis and opportunity over the last 70 years has been tracked in the deep down in the spreadsheets and also in the analysis that we have been doing. And so this is an opportunity to look back and think about what it means for looking forward. So as I mentioned, I'm going to start out with just what happened last year. How surprising was it? How we learned then about how the system responded to the COVID stress test, and then think about the progress that the world has made since the Paris Agreement was concluded. And so last year, clearly, as we all experienced, GDP contracted by the most since World War II. And even as we look forward into 2021, I suspect that we will find again that the rebound in economic activity is not going to be as V-shaped as we all would have liked. Of course, there are going to be some countries that have emerged from this crisis much more quickly than others, but the delays in vaccination and the problems that we're seeing in terms of the economic recovery and frictions in the labor market, all of that is going to continue to bear down on the ability of the world economy to recover from this crisis. So all that aside, all that economic thought aside, what's important for us is to think about what happened to the energy system. And what these two charts are showing here is that energy demand and CO2 emissions were basically falling and moving in lockstep with one another last year. Energy demand fell by about 4.5%, and carbon emissions from energy use also fell by about 6.3%. So these large falls, of course, just as much as the fall in GDP that we saw, were the largest that we saw since World War II. And indeed, that reduction of 2 gigatons of CO2 means that carbon emissions last year were basically back to levels that we saw in 2011. Now, when we look at the components of energy demand, you see different stories. So overall, primary energy down by about 5%. But the biggest decline that should stand out to all of you is the decline in oil demand. And that shouldn't be surprising because we all experience it as transport sector, as the transport sector was locked down and personal behaviors meant many of us stayed home. The other interesting bar here in this chart is the lack of a decline in electricity demand at a global level. And there are various reasons for that. So this is what it looks like at a global level. What does it look like in the US? Same thing, but the thing that should stand out to you here is the very large decline in coal use. And so that came from switching in the power sector. And at the same time, primary energy fell by more than it did, or a greater percentage than it did in the rest of the world, largely driven by that reduction in power demand that you see over in the purple bar on the right, and also because of that decline in coal. It made it disproportionately higher than what you saw in the rest of the world. Now, both of these declines and the declines that you saw in several other industrialized countries are in stark contrast to what we saw happening in China. So in China, despite that GDP growth slowing to just 2% from 4, 5, or 6% as we saw in the last couple of years, you still saw this very strong growth in carbon intensive energy last year, energy use and energy production last year. And we can come back and talk about that later on. But I think it's important to highlight just how much the Chinese economy continued to grow despite, it's interesting to look at just how much energy consumption and energy production continued to grow in China despite GDP growth contracting much more than it has in history. Now, what does this mean overall from a carbon emissions pathway? So we saw last year a 6% fall in carbon emissions. And yeah, that 6% fall looks great, but it's that kind of fall that we need to be able to see next year and the year after, and basically for the next 30 years to get down to the kinds of pathways that are consistent with a Paris Agreement. And that 85% decline, similar to what you see from the IEA's Sustainable Development Scenario, similar to what you see from BP's Rapid Scenario and other deep decarbonization scenarios, needs to see that kind of 6% decline next year compounded in order to be on a pathway. The problem is that the decomposition that I showed you means that the 6% decline that we saw last year is likely to be temporary. What I mean by that is that both the fall in primary energy and the fall in carbon intensity shown here in this chart in orange are both directly related to the fall in oil demand. And so therefore, as the virus is brought under control over the second half of this past year and hopefully in the coming year, we're unfortunately going to see that reduction in carbon emissions being reversed. And so the important thing here to take away is that we need to see that on a more sustainable basis. We need to see that kind of adjustment without the very strong contraction in economic growth that we saw in the economy last year. And what we did is a very simple exercise in trying to think about what does that contraction in economic activity mean for what kind of carbon price might be able to bring that about. So just basically looking at a carbon price, so this is dollars per ton, what is the value of that on a per ton basis? And it equates to carbon emissions that would be equivalent to that kind of fall in nominal GDP of about $1,400 per ton. So this is, of course, a really scarily high number. And the moral of the story is that locking down the transport system, locking down our economies is something that we want to avoid. And we need to be able to do this reduction in carbon intensity, this reduction in primary energy on a more sustained basis so we don't see such a disruption to our way of life. Now, the other interesting thing here, to come back to what's happened in oil demand, is that when we think about oil demand, it represented about 3/4 of last year's decline in energy consumption. And it was, as I mentioned, that key factor for the near record fall in carbon intensity of the energy mix. And the US alone, oil consumption last year fell by about 2.3 million barrels a day, the most of any country. And that accounted for about 1/4 of the decline in oil demand. So why am I mentioning this? I mean, when we look at what it looks like on the scale overall for global CO2 emissions and US CO2 emissions, the oil intensity of the US economy presents not just a challenge for decarbonization, but also an opportunity. And I think this comes back to the role that energy companies and the energy centers can play going forward in reducing the carbon intensity of the transport sector, of the power sector, and the energy sector itself. So when we think about the outside of just the travel and transport sector, power sector emissions also fell last year very, very sharply. But as I mentioned, it's because of that reduction in coal-fired generation. Now, to move on to the second part, what did we learn last year? When we think about engineering, we often think about stress tests. So what did we learn about how the energy system responded last year? So again, to start very briefly with oil, and I'm going to go into natural gas as well. The oil market in 2020 featured 3 different phases. So the first phase was this disconnect between demand and supply. We saw stocks start to rise. We saw a failed OPEC meeting. Prices fell to negative levels for WTI and to very low levels of $20 for Brent. Then finally, we saw some reduction in OPEC supply and other non-OPEC supply. We saw an agreement as we moved into the second quarter of last year. And we started to see some very cautious rebound in oil demand as trade picked up and as people ventured out for summer vacations. And so that led to a reduction in the buildup of stocks, but they still remained at a very high level. And this should be familiar to many of you that followed the oil market last year. The third phase, which we're still in, is one where we're starting to see that excess stock being unwound, that excess, that amount that is in addition to the average that we've seen over the last several years. Now, what can we learn from this? What we can learn from this is that, of course, OPEC Plus was willing and able to stabilize the market in the face of a temporary supply or demand shock. But we have to all be asking ourselves the question whether this is going to continue to happen. And it is likely going to depend on the nature of the shock, the nature of OPEC to respond to a more permanent shock that might come as a result of an energy transition, as a result of a plateauing in oil demand, or even a decline in oil demand in some scenarios. How OPEC responds to that is not necessarily going to be the same as the way in which they might respond to a more temporary shock. And instead, they might focus more on preserving market share rather than maximizing revenue. Again, when we think about the oil market as well, the demand contraction that we saw in World War II was off the charts. So we saw the use of jet fuel and kerosene decline by something like 30, 40%, 3+ million barrels a day as aviation across much of the world was grounded. Similarly, gasoline demand fell by around 13% as mobility measures crashed. And I would say in contrast, the products that were most closely related to the petrochemical sector, so naphtha, ethane, and LPG, were broadly flat and supported in part by increasing demand for PPE and other medical and hygiene related supplies. Now, the interesting thing, which hasn't really gotten talked about a lot among some of our other public presentations, is the impact on the refining sector. And I think this is worth a little bit of a discussion on. Now, I think that as we are looking forward into the next 2 to 3 years, we're going to see a healthy bit of new refining capacity being built in non-OECD countries. And the price pass-through in those non-OECD countries may differ from the way that prices and margins are passed through in OECD countries. And what we saw last year and what we are seeing over the course of the last decade is that the share of refining throughput that's coming from OECD countries is declining every year. And so what that means is that in countries like in the United States and like in other industrialized economies in Europe, for example, the price pass-through is having a direct impact on refining throughput and refining capacity needs. And so I think it's important to reflect on the fact that in the coming years, just as much as we saw last year, the elasticity of OECD refining throughput is increasing, and we're likely to see more and more refining closures as the share of non-OECD refining continues to increase. Why do I show this? Because it's interesting. It's interesting to be able to look at the data series that we provide, and I don't see a lot of other people providing global free refining throughput series to try to think about what this means for the future of refining throughput and refining capacity. And also refining centers like PADD 3 and the US Gulf Coast. Now, when we think about the gas market, LNG imports increased in recent years into the European market. And of course, this raises the question about the extent to which Russia and other pipeline gas exporters into the European market are going to compete against LNG suppliers like from the US to maintain the Russian market share in those markets, or instead forego some of that share to avoid driving prices too low. And so again, just like the example that I mentioned with OPEC and OPEC Plus, this issue about the extent to which Russia and other pipeline suppliers are going to flex or forego their market share is going to become more acute in the face of something that's not just a temporary shock, but is something that's more of a transition over time as Europe attempts to move away from natural gas and as that competition among different natural gas suppliers intensifies. And so we saw this case in point last year, right? If you look at what happened in terms of US LNG utilization rates, LNG exports increased last year, something like 30%, and are now accounting for 13% of global LNG trade on average. But when you look at it on a month-to-month basis, shut-ins never really occurred at scale. We actually saw that last year when short-run operating costs that are shown here in this red chart, in the red line, fell below prices. And as a result, utilization rates fell. Russia pulled back later on and allowed those LNG imports to continue. But the European market, I think, is important to look at as a barometer of those global gas trends. But it's also important to look at for US LNG exporters. So right now, US LNG exports into Asia account for 5% of LNG imports. They account for something like 20% of LNG imports into Europe. And so over the long term, if these countries that are consuming that natural gas are seeking and are increasing their pledges to achieve a net zero pathway, if that results in less demand for natural gas, then LNG exporters need in the United States and elsewhere need to start finding other markets and more diverse markets for that. And again, it's great. You can do this analysis with the statistical review. You can look at what the share of LNG exports, and you can look at shares of oil trade, shares of natural gas trade with the statistical review and the spreadsheets that are made available. Now, the last section, what's been the progress since Paris? How has the world been doing? And I think this is an opportunity to look at just how quickly wind capacity and solar capacity have been growing over the last decade. So the annual change is what's shown here, both for wind and for solar capacity. This is the delta, the annual delta. It's doubled in both solar. Well, it almost doubled in solar, and it definitely more than doubled in wind in 2020. And when you think about this on a generation basis, it's these kinds of trends that the world needs to see every year. So this is very similar to the kinds of pathways that are shown in IEA Sustainable Development Scenario and in the BP Rapid Scenario. And that strong growth in variable renewable energy is crowding out coal. And that line that's shown here on the right in gray is bending, albeit very, very slightly. And so I think the point here is that despite this very strong growth in variable renewable energy that is beginning to displace coal, sometimes more so in other countries, it's going to take more than that. It's going to take more than that in an environment where energy demand is not contracting or level, but where energy demand is growing. In order to stop the continued carbonization of the energy sector. So what I'm saying here is that it's all fine and good for renewable energy to increase. We want it, we applaud it, it's important. But in economies where energy demand is growing by leaps and bounds, variable renewable energy is not enough to satisfy it. And what we showed in previous statistical reviews in 2018 and 2019 is that energy demand growth is so fast that coal is swooping in to take some of that share and maintaining its share in the overall power mix. And again, the wonderful thing about this statistical review is you can look at this very easily and look at the power mix over time. So for the US, the coal curve and that coal line is bending. Last year was interesting. Even as gas's share reached 40%, so for natural gas, that's the red line, the increase on a terawatt hour basis was half as much as the increase in renewable power generation. So the renewable power generation is shown there in orange. Now, in the rest of the world, neither the curve for natural gas nor the curve for coal is bending nearly as much as it has in the United States. And I think it's important that to, again, reflect on why that is and understand that we need more than just an increase in renewable energy to continue to decarbonize the power mix. Of course, it's going to contribute, but we need to ensure that the power that is being consumed is as low carbon and on a pathway to a lower carbon as much as possible. And so when you think about energy access, so what has happened in the last 5 years? There's been a lot of attention in the Paris Agreement on the response to climate change. And the agreement stipulates that this response should be just in the context of sustainable development and efforts to eradicate poverty. But there are really important interconnections between these goals and the energy system, including focusing on conservation and biodiversity, both on land and in our oceans. But the most important is SDG 7. So this is the Sustainable Development Goal that is trying to ensure access to affordable, reliable, sustainable, and modern energy for all. And what this chart is showing here is that significant improvements have been made. That 15% of people that if you look at the number of people without access to electricity between 2015 and 2019, it's down 15%. It's down to something like 10% of the world population. So 1 billion in 2015 to a little over 750 million by 2019. But these improvements have been uneven. And in 2020, which is not shown in this chart, COVID has reversed the decline. And so the Energy for Growth Hub estimates that the minimum that the UN is using is not a sufficient minimum. And they think that we would ought to have a modern energy minimum of something like 1,000 kilowatt hours per year. That's something like 4 times greater than the UN definition. And so based on that definition, and what we're talking about here is more than just being able to turn a light bulb on and off during the day. It's something that's greater than that, that is able to support strong and sustainable economic growth. And so if you think about that higher estimate, there's 3.5 billion people that are still living below a world energy, a modern energy minimum. And that represents that 3.5 billion people is half of the world's population. Now, why do I talk about this in addition to the fact that it remains a very important problem? I talk about it because there's wasted energy. And this year we tried to address the flaring intensity and overall flaring in our data. This is data that you may be familiar with. It's also being reported by the World Bank. We took a slightly different approach and are trying to look at it not just for the upstream, but also for the downstream. And so overall flaring is 150 BCM. That's a lot of natural gas. It's a lot of natural gas that's wasted and a lot of gas that could be used for other more productive purposes, such as reducing the energy poverty problem. And so when you look at the progress that we've made in the last several years, unfortunately, it's not improving. Depending on how it's measured, it's either the same or slightly worse than it was during the prior 5-year period. Now, in the US, gas flaring fell by 5 BCM last year, about 30%. And that accounts still, though, for about 8% of global flaring. So we're always trying to improve. Last year, this was one improvement. The capacity data for electricity was an improvement. Clearly, there's a dichotomy and a continuing diversion between what is stated as hopes, net zero hopes, and the ambition, and what is actually shown in reality. So I think that it's important to reflect on this. If you look at what happened over the last 5 years, energy emissions just continue to decline, and over the course of energy emissions just continued to increase, and it declined in 2020, back in line with some of the forecasts that we've seen in the past. But as I've said, this is something that is just likely to be temporary, and we're going to be back on that more unsustainable pathway with an even steeper hill to climb to decarbonize going forward. So I think there's a lot more to do, and I want to just conclude with a couple key takeaways. And just to summarize this for those that may have tuned in slightly later. So when it comes to both OPEC's response and Russia's response, their response to temporary shocks is going to differ from a more permanent shock to the energy transition. And I think those that are observing markets and those that are making investment decisions need to reflect on that and what that might look like, not just over the next year, but over the next 10 and 20 years. Second point that I've made repeatedly just relates to the growth in renewables. We want it to grow. It grew something like 300% over the last 5 years. And that growth happened despite the supply chain issues, but it's not going to be sufficient in a world where energy demand is continuing to grow at the pace that we've seen in the last several years. And so we need to see other solutions. We need to see hydrogen and CCUS. We need to see energy efficiency. We need to see other low carbon solutions, of which many of you are very familiar with and are working on. So we are too late to this challenge, and we cannot exercise being particular about what low carbon solution allows us to get back onto a more sustainable pathway. As I said, that 6% is going to be erased as soon as we come out of COVID. And the challenge, as I mentioned, is to do that kind of reduction without a $1,400 carbon price, because that's just something that none of us want to have to swallow. And then finally, I'll just echo and reinforce the message that I said before. There is going to be growing demand for reduced carbon intensity energy, and half of that world is still at an energy level. Half of our world is still at an energy level that is below a modern energy minimum. And so our challenge is to capture and measure and identify those sources of energy that are wasted in order to monetize them and to provide those people that fall into that share of the population with a more sustainable solution going forward. So with that, Mark, I look forward to our questions, and I'll stop sharing here.
Awesome. Thank you, Michael. For a great presentation, already getting lots of great feedback, from a very large webinar audience, by the way. I want to, in addition to thanking you, I'm going to spend a few minutes filibustering to give our audience a chance to type their questions in using the Q&A function, as well as to give Michael a chance to catch his breath. I wanted to note that Michael, that BP produces a companion piece of analysis to the statistical review, an annual long-term world energy outlook. Michael made several references to some of the scenarios that BP produces in the forward-looking portions of his commentary, and that is also available on the webinar on the BP website. And we will look forward to hosting Michael and his colleagues when the next edition of that comes out as well. When is that slated for, Michael?
I would say sometime in 2022, but unclear when.
There you go. Okay, sure. All right. Well, while I give people a chance, and thank you, there's already some really interesting questions coming in. Let me ask, I want to have two questions, and if thanks for all of you for permitting me that prerogative. Number one, Michael, you mentioned specifically went out of your way to mention China and how China seemed to buck the trend in terms of both growing demand and growing supply of energy last year. As a companion piece of that, you made several mentions to trade. And one of the things you can pull out of the BP data is that global trade in oil, gas, and coal all fell more rapidly than underlying supply and demand. And my question to you is, looking at the China situation and the broader trade dynamics in COVID, is that, something that we need to be worried about in terms of growing protectionism around the world? Or is there a more sanguine explanation for what we observed in China and globally with trade?
No, I mean, I think that it is something that we need to be concerned about. And we clearly saw that supply chains were affected last year. And we saw that trade as well contracted. And I think one of the issues that we looked at in our scenarios in the energy outlook last year is a deglobalization scenario in which rising tariffs and other protectionist behaviors led to a lower energy demand pathway than in some of the BAU or other the business as usual types of scenarios. So it's clear that that's going to have an economic effect. And it's clear as well that it's going to have an effect on the ability of new energy and new decarbonized energy in some cases to penetrate into markets where it ought to go if those protectionist measures were not there.
Yeah. Okay. Thank you. Well, and we'll all be watching that, as a key issue going forward for sure. Mm-hmm. You mentioned at one point the notion that the challenge of the energy transition also presents a significant opportunity for the fossil energy industry. And given that, Rice is Houston-based, and as is a lot of our audience, there's a lot of interest in Houston about how to leverage its expertise to maintain its position as the world's leading energy city, in a transition. And I'd be interested in your thoughts on what specifically about the fossil industry do you see as an opportunity
heading into this transition?
Yeah, no, it's a great question, and I think that at the end of the day, my answer to this comes down to one real point. Everyone needs a seat at the table, right? There is no way that we can possibly create and grow enough new green companies, new renewable energy, battery producer, what you name it. There's no way that you can produce enough green companies fast enough to solve this crisis. 70% of global emissions come from energy consumption across energy, the energy sector, the industrial sector, and transport. And it's clear that these sectors need to be transformed. And like I said, it's great that renewables are growing. We are investing in it ourselves. So are many of our peers. It's grown, 300% over the last 10 years, but it still represents only something like 5-6% of global energy demand today. So you need these companies that are at the heart of the energy system. And many of those energy companies either have operations or even headquartered in Houston. And that Gulf Coast Energy Center is critical overall for how the rest of the energy system is going to evolve. But we need society, you need investors, you need governments, both big and small, to help support these companies that have an aspiration to greening companies. And I think these companies that may not be low carbon today, but have an ambition to become low carbon, are really important. And these companies have scale, they have capabilities to make the energy system greener and rapidly. Now, I think when you think about Houston, so that's the kind of overall for energy, for the energy industry and for the energy industry in Houston. But a lot of this we're already seeing happening. Houston, think about it. It's the center, and Pad 3 and the Gulf Coast area is the center of energy transformation. I think it's hard to come up with any other energy center across the world that is more of a nexus for that energy transformation other than the Houston and broader Gulf Coast and Louisiana area. And from a metro perspective, it's the fifth largest fifth largest city in our country. It's the largest fuel producing region in the Texas Gulf Coast. When you think about which companies are already started along this pathway, when it comes to CCUS, Talos and ExxonMobil have already announced innovation zones. You're seeing announcements around CCS capture that from Sempra, from Cheniere. It all comes down to having the sources and the sinks available in the country, in the general area. And when we think about CCS and hydrogen opportunities, having those sources and sinks of carbon make it a very attractive place for this to happen. And BP has noticed this. We have a partnership with the city of Houston. And like I said, we need to have action. We have these aspirations, but there needs to be more action on the ground. And we're working to establish charging hubs for EVs. We're sponsoring Greentown Labs, all of which is going to support and establish Houston as a hub for clean tech innovation. So anyway, hopefully that answers a question around what role does Houston and the energy industry play.
Yeah, thank you again, Michael. And you're right that it's attracting a lot of attention. And I've just posted in the chat function for our audience an example of the type of work that's relevant to this vein that is being undertaken here at the Baker Institute Center for Energy Studies. We have gotten, Michael, several questions about flaring. So that you mentioned that was a new data series that you added this year, and questions have come in around how do you gather that? I mean, why is it mostly associated gas? Is it exclusively? Why is Iraq so bad? So would you mind speaking a bit to the process by which you put this information together and what light it sheds on those specific wrinkles?
Yeah, so this is surveyed at from satellites. They are
The technology is something I don't think that I'm able to speak to directly, but when we partnered with the Payne Institute at the Colorado School of Mines to measure and use their measurements from their satellites of the amount of natural gas and methane that is flared into the atmosphere. And they collect that data at a point source level, and they aggregated it for us and as well for the World Bank at a country level. And so this is the first time that a comprehensive country level data series was produced, and a time series was produced. Because if you go to the World Bank website, and if you are familiar with this data in the past, sometimes the World Bank would very nicely and kindly produce the data, but just for that year or just for certain countries. But in order for us to take account of it in the broader scheme of carbon emissions and carbon emissions equivalent, we needed to have it at a more granular and country level. So this is very comprehensive upstream and downstream. It's not just associated natural gas flaring. There's obviously a methodological question in terms of how you calculate intensity. Are you calculating intensity of flaring per natural gas billion cubic meter BCF produced? Are you calculating it based on the amount of oil plus natural gas produced in a various way? Or are you doing it just based on the amount of oil that is produced? So that's a methodological debate, which I'm not going to get into, but that there are various ways of looking at intensity. And I think the takeaway for me was just that, unfortunately, despite all of the press and all of the activity, the intensity at a global level is not really decreasing. And that just means we need to do more. And the onus for that social license to operate then revolves and centers on us in the industry to try to make that happen.
Right. And as you point out, it's a missed opportunity in the sense that it represents a significant chunk of energy that could otherwise be deployed to raise those living standards that you mentioned.
Right.
As a quick aside, does that same methodology allow for the tracking of methane venting, direct venting rather than flaring?
So it can and it will. The data remains patchy, and there are definitional and measurement issues. That means that I would expect in the next 1 to 2 years that there will be a lot more data and more transparency around not just the flaring, which is converting it into CO2, but more the direct CH4 venting and fugitive emissions that are coming from the energy sector, because that's big. The IEA has some estimates of that, but there is a healthy bit of assumptions and other methodological questions around the way in which some of that data has been produced. So it's not the definitive source yet, and I would expect that in the coming 1 to 2 years that there will be other sources that will help with this. And of course, BP is doing its own measurements and trying to assess that. But I'm looking forward to the technology continuing to evolve to be able to track those non-flared CH4 emissions.
And we'll know it's at a sufficient state of quality when the table appears in a future edition of the Statistical Review.
Let us hope. Yes.
So there, Michael, been several questions around this concept of the energy minimum. And just in terms of trying to dig a little more deeply into what exactly we're trying to conceptualize here, but also, well, how do you take into account prospects for conservation or greater efficiency of energy use when we think about what the world and especially emerging countries and poor people around the world need to get by on?
Yeah, so I want to give credit where credit is due. There's a paper that was written by Todd Moss, who leads the Energy for Growth Hub, and Morgan Bazilian at the School of Mines, as well as a whole host of other academics that I'm happy to put in the chat or you can provide later. But I think that the per capita energy consumption, the basic point here is that the per capita energy consumption needs to be at a far higher level than defined in SDG 7. And there is no high income country that is low energy. And we see this very, very tight correlation between income and electricity consumption. And we've seen that through time and time again. And so when you think about the energy consumption minimum that's defined in some of the UN work, it just, basically it just needs to be higher. And in order to address that going forward, it means that there's a far higher amount of energy poverty under this new definition than what is described by SDG 7. So there's a lot of work that needs to be done on this, both in terms of measuring and also it goes back to this more energy, less carbon kind of narrative. And I think that there are certain places in developing countries where we need to be acutely aware of how that decarbonization pathway proceeds, especially over the next 5 to 10 years, and making sure that those populations have taken into account any kind of lock-in concerns, but also have something that is not coal to burn for their electricity.
Okay. One of our colleagues here at the Baker Institute, Francisco Minaldi, has pointed out that Todd Moss is also a non-resident fellow here at CES.
Great.
So thank
Great.
you for the shout out.
Yes.
There have been several questions around the BP outlook, Michael. One is, you had a more aggressive scenario that had $100 a ton for an implicit carbon price or an assumed carbon price. Another around your assumptions and views on potential for autonomous vehicles. At the risk of diverting attention away from the statistical review and into the more of the forward-looking stuff, how does BP see those two questions?
So in terms of the carbon price assumptions used in the energy outlook, at the end of the day, they produce a wedge between producer and consumer prices. And in modeling, that consumer price brings about behavior, brings about change in the energy system as it is passed through to the end user. And to fully flesh out the various possible energy pathways, we have to use carbon prices as a way to try to understand the implications for how the energy system will evolve. And in a BAU scenario, the industrialized country carbon price never gets higher than 100 or 150. And in fact, by something like 2050, and it stays and remains very low throughout the first decade or decade and a half. But in the rapid and the net zero scenarios, the carbon price increases quite rapidly, out to $200 or $250 per ton in those scenarios. Now we know, and that everybody that's tuned in here knows and understands that the carbon price is not the only way to bring about change in the energy system. Subsidies, taxes, and other market mechanisms and non-market mechanisms are going to be able to do that. The carbon price, though, in our modeling acts as a proxy for some of that, and a sort of shadow price to bring about those changes. So hopefully that explains that part of the question. The other part of the question was on autonomous vehicles.
Right.
So the experts at UC Davis, Dan Sperling talks about 3 revolutions, right? The revolution in electrification, the revolution in autonomy, the revolution in shared mobility, right? And when we think about how that may play out over a long term, autonomy plays an important role in driving up the electrified vehicle miles traveled or electrified vehicle kilometers traveled. And it is something that we continue to hold in our outlook. It drives up that rate later on in the 2035 to 2050 timeframe. But there have been clear challenges with autonomy lately. Of course, investor interest is still there. A lot of different companies trying and building in various amounts and levels of autonomy, not full level 5 autonomy, but various levels of autonomy in the technology that OEMs and car companies are offering. But stay tuned for the next Energy Outlook, and I'm sure we'll have more to say on that.
Great. Yes, I'm still looking forward to being able to jump in my car and just take a nap and say, take me to work. Of course,
Yeah.
these days with COVID lockdowns, I'm just looking forward to be able to jump in my car.
Yes. Yes.
So if you thought you were going to get away without having to talk about the oil market, Michael, I'm afraid we're going to disappoint you with the last question. Is that I'm going to put two together. One was very short term in saying, how are you reading the market right now? And the particular question was in the context of the administration's request recently for OPEC to raise production, and how are you seeing, the kind of balance of supply and demand, but also the tension apparent between climate aspirations and kind of short-term considerations around the price at the pump. On the longer term, the question is around, so when you say that Russia and OPEC will react differently in the face of structural change, are you specifically talking about them trying to grow production and live with lower prices, and elaborate a bit on that theme?
Yeah, so I mean, in the short term, obviously we don't talk publicly about our market view, but I do think that there are a couple key facts that we all are clearly aware of. Number one, oil demand has not rebounded at a global level yet, and there remain uncertainties about vaccine deployment, and the ability, of employment and other labor markets to fully rebound in the aftermath of what has been a very serious pandemic-induced shock. It is fascinating that we have 6 million people out of work, and yet productivity and the level of GDP here in this country is back at levels from pre-pandemic. It's a statement and a testament to the improvements in productivity that we are all experiencing. Now, what this means in terms of where oil prices go, nobody knows, and I'm not going to speak about it publicly, but it's clear that OPEC has an interest in seeing a balance and a continued reduction in the excess inventories that have been built up over the last year and a half, and they have proven 100% plus. They've proven that with 100% plus compliance, and of course we're going to see peaks and valleys in terms of that as other disrupted supply comes on and off. But I think the track and the momentum is clear, that eventually that excess stock level will go away, and we'll have to contend with a new normal level of stocks, because these stock levels, every single time we go through another disruption, whether it's 14 to 15 or 2008, 2009, we reset that normal level of inventory. So I think there's a lot of interesting analysis that can be done around that. Now, long term, the paper that my boss Spencer Dale wrote around what is the pace of economic diversification, is something that I think will determine the ability of producing countries to weather a lower oil price environment, again, over the long term. And I think that as we move forward into the 2030 and 2040 timeframe, there are a whole host of other issues that are going to be that those producing economies will have to contend with, and their ability to restructure their fiscal stance and their economic structure is really going to be the key determinant for how low prices could end up going, and their tolerance for a lower price level than where we are maybe today or in the future on an adjusted basis.
Mm-hmm. Great. Certainly. Well, we'll look forward to having you back to talk more about that.
Yeah.
And next time. But for right now, I'm afraid that we're almost out of time.
Yeah, can I just interrupt Mark for 1 second? I mean, I'm fascinated by both the number of people and the number of questions that we were not able to get to. So I urge all of you to please don't hesitate to reach out and engage with us on these issues. It's really great to see both friends and former colleagues on here. So.
Absolutely. And if I didn't mention already, I apologize. We will get Michael's slides up on the website after the event as well. Boy, we covered a lot of ground. And we could easily keep going. The turnout, the number of questions are a testament to the information contained in the statistical review, as well as your ability to present it, Michael. Some things are just too cool to pass up. When my daughter was young, she played the tuba. And I told her, if you keep it up, even I might allow you to apply to Ohio State. Now, because even for a Michigan man like myself, the Ohio State marching band's tradition of writing a script Ohio on the football field and dotting the I with a tuba player or a sousaphone player is pretty cool. And please don't tell Coach Harbaugh that I said that. Now, for an energy nerd like me, the annual publication of the statistical review is also too cool to pass up. It's a great opportunity to step away from the daily noise around us and to just look at objective data to help get a better understanding of the world around us. So, Michael, thanks to you and the team at BP for preparing it and for sharing it with us today. I'd also like to thank the team at the Baker Institute for their technical assistance in producing today's webinar. And most importantly, thank each of you for joining us. I hope you found the discussion to be helpful, or rather, to be too cool to pass up. If you haven't already, please take a minute to connect with us on Twitter or LinkedIn to stay in touch with the Baker Institute, our researchers, and events. And one final word to those of you in IDA's pathway. Our thoughts are with you. Stay safe.
Thanks, Mark.
Thanks again. Thanks everyone. I hope you all have a great weekend.
Bye-bye.